When you think about investing, what's the first thing that pops into your head? Is it maybe those high-flying, super volatile tech stocks? Well, today we're going to look at pretty much the exact opposite. We're diving deep into the Canadian banking sector, a corner of the market that people often call a fortress for investors. So the question is, does that reputation actually hold up in 2025? Let's find out. Look, if you're an investor and you're tired of the roller coaster, if what you really want is stability, a steady stream of income, and a business that's just built to last, you've probably kicked the tires on the big banks before. But the real question is, right now, in this really complex economy, do Canada's top banks still offer that safe harbor we're all looking for? So here's how we're going to break it all down. First, we'll get into why people even call it a fortress. Then we'll look at the economic currents, the good and the bad, that they're navigating right now. After that, we'll meet the big six players one by one. And finally, we'll wrap it all up into a kind of playbook for you as an investor. So what makes this system so special? I mean, really, what's the secret sauce? Well, it all boils down to one key idea. Canadian banking isn't just a bunch of competing companies. It's a structured, heavily protected oligopoly. And that structure, right there, is the source of their incredibly deep economic moat. You know, at its heart, an oligopoly just means that a tiny number of players dominate the entire field. And for the Canadian banks, this isn't an accident. It's a structural reality. It means less competition, which gives them serious pricing power. And that's what really props up their stable, long-term profits. And when we say dominate, we mean dominate. The scale is just staggering. The Big Six control over 90% of all banking assets in the entire country. Think about that. When you have that much market share, you're not just another business in the economy, you are a fundamental piece of the economic infrastructure itself. This is the bedrock of the entire investment thesis. And this fortress, well, it has a very powerful gatekeeper, the regulator, known as OSFI. And they enforce some of the toughest banking rules on the planet. I mean, just look at that domestic stability buffer. That's a mandatory capital cushion they force the banks to hold just in case things go south. And this isn't just an internal thing. This stability was just recently given a big stamp of approval by the IMF. So how do we actually measure all this strength? Well, the key number you need to know is the CET1 ratio. The easiest way to think about it is like a bank's ultimate rainy day fund. The higher that number, the better it can handle unexpected losses without breaking a sweat. And Canada's big banks have to keep these ratios super healthy, way above the global standard, which is exactly what you want to see if you're a cautious investor. But you know, no fortress just sits there by itself. The Canadian banks are right in the middle of a shifting battlefield, with some really powerful forces pushing and pulling them in opposite directions. So let's dig into that, because it adds a lot more nuance to the story. So on one side, you've got the headwinds, the tough stuff. Things like trade tensions with the US, a bit of a slowdown here at home, the constant threat from fintech companies, and a housing market that's cooling off. But on the other side, you have a really powerful tailwind pushing them forward. The Bank of Canada is cutting interest rates. That should make borrowing cheaper and give some much-needed breathing room to homeowners. And this forecast kind of lays out the environment they're working in. You can see the economy is expected to speed up a bit as those rate cuts kick in. But take a look at the housing market. A modest 2% price dip is what's expected. It's not a crash by any means, but it's a definite cooling, and that's something the banks have to carefully manage. Now, that housing risk is definitely real, especially since Canadians carry a lot of household debt. But, and this is a huge but, there's a critical defense mechanism built into the system. It's the mortgage stress test. Since 2018, it's forced every borrower to prove they could afford their mortgage at a way higher interest rate. The key point here is that this built a massive safety buffer into the system that just wasn't there in previous downturns. All right, so we've set the stage. We get the structure, we get the environment. Now let's actually meet the champions on this field, the big six banks themselves. Because each one of them is a little different, with its own unique personality and strategy. Here's a quick snapshot of our players. You can see their capital strength in that CET1 column, how the market values them at the forward PE, and the income they spin off through their dividend yield. Kind of keep this table on the back of your mind as we go through each one, because these numbers tell a really interesting story. First up, you've got Royal Bank, or RBC. This is the undisputed king of the hill. It's the biggest, it's the most diversified, and it almost always trades at a premium price precisely because it's seen as so rock solid. And the recent buyout of HSBC Canada was just a massive power move, absorbing almost 800,000 new customers to really cement that number one spot. Next up is TD, the cross-border giant. It has a massive retail network in the United States, which really makes it stand out from the pack. But it's facing a pretty big headache right now with U.S. regulators over its anti-money laundering systems. The silver lining here, look at that CET1 ratio, an incredible 14.9%. They have an absolute fortress of capital to help them work through this issue. Then we've got Bank of Nova Scotia, or BNS, better known as Scotiabank. Their big bet is on international growth, especially in Latin America. Now, that strategy has been a bit of a struggle lately, and the bank is right in the middle of a big strategic turnaround. And that super high dividend yield of almost 6%, well, that's the market basically telling you it sees a bit more risk here, but also maybe a bit more reward if they get it right. BMO's whole game plan is to build one single, seamless North American bank. And their recent purchase of Bank of the West out in the U.S. was an absolute game changer, hugely expanding their footprint south of the border. And get this stat. BMO has paid a dividend for 196 years in a row. That is an unbelievable track record of stability. CIBC is the most all-in on Canada of the big banks. That makes it the most direct way to invest in a Canadian economic recovery. They have been nailing their turnaround, and they're a real leader in digital and mobile banking, which customers love. And that recent 15% pop in their quarterly profit, it's pretty clear proof their strategy is working. And finally, we have National Bank. Now, it may be the smallest of the six, but it is an absolute giant in its home province of Quebec and a beast in capital markets. And it just made a really bold move, buying Canadian Western Bank to go from being a regional champ to a true national contender. On top of that, it consistently cranks out the highest profitability of the entire group. Okay, so we've met the team, we've surveyed the playing field. Now for the most important part. Let's pull this all together and think about how you, the investor, could actually build a playbook with all this information. First things first, let's talk price. So you can see that on an earnings basis, they're valued pretty similarly to their US peers, but the real story is that price-to-book ratio. There is a consistent, long-standing premium for the Canadian banks, and that premium really is the price investors have always been willing to pay to get access to the stability of that oligopoly system. So the key takeaway here is that your choice really depends on your goal. If you want maximum sleep-at-night stability, RBC is the classic blue chip. If you want a piece of U.S. growth, TD and BMO are your go-to options. If you're okay with a little more risk for potentially more reward, you look at Scotiabank's turnaround story. Betting on a Canadian comeback, CIBC is your purest play. And for unique growth story, National Bank's expansion plan is super compelling. And really, that brings us right to the main conclusion. There's no such thing as the single best Canadian bank stock. It just doesn't exist. There is only the best fit for your personal investment strategy, your goals, and your comfort level with different kinds of risk. It's all about matching the bank's profile to your own. And all of that leaves us with one final big picture thought to chew on. For more than 100 years, this Canadian banking fortress has been incredibly resilient. But in a world where technology and fintech are changing everything at lightning speed, the ultimate question for any long-term investor has to be this. Can this fortress, and all the advantages that come with it, really hold on forever?